Welcome to Fairport Flash, the monthly economic update powered by the Fairport Investment Team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Hi, I'm John Silva, Chief Investment Officer of Fairport. So it's been a while since my last podcast in February. To say it mildly, a lot has happened and a lot's been going on. I thought we'd check in on the markets, the economy, and what clients are asking us. So let's get right to it. After dropping to a low in December, both the S&P 500 and the NASDAQ Composite reached new highs in the month of April, reestablishing an uptrend in the markets. Overall, equity markets have bounced back with both large and small caps leading the way. International markets, both developed and emerging, have lagged domestic equity markets here in the U.S., but both have had returns of over 10% through the month of April. Overall, cyclical sectors of the market, those that benefit when the economy is improving, like technology, energy, and industrials, have led the way, while defensive sectors such as consumer staples, utilities, and real estate have lagged so far this year. We remain overweight cyclicals, and we believe they will continue to outperform heading into the midpoint of the year. However, since May, equity markets have pulled back a bit as trade talks with China have hit an impasse. As a result, the S&P 500 is down about 3 or 4% from its high. So according to Ned Davis Research, a decline of 5% in the markets happens about every 84 trading days. We are currently at 90 trading days. So from a historical standpoint, we're probably overdue. With that being said, we don't see it as a big concern after the run-up we've seen in the first 4 months of the year. As we look a little further out, we should see a tailwind remain for the rest of 2019. According to Strategic Research, after 4 positive months to the beginning of the year, so January, February, March, and April were all positive, you tend to see positive returns for the remainder 8 months of the year. 15 out of the last 16 times that's happened, we've seen a return of over 10% in the last 8 months of the year. But you also do see a drawdown of about 8% during that time frame, and we may be experiencing that right now. As we move to the economy, we believe any fears at the beginning of the year that we would see a recession in 2019 have faded considerably. GDP, or gross domestic product, grew at 3.2% in the first quarter of 2019. That puts us on the path for growth to be in the 2 to 2.5% range for 2019. The job picture looks to be improving, with unemployment rate dropping to 3.6% in the month of April. That's near a 50-year low. And we saw the economy add over 250,000 jobs in the month of April. Other measures that the economy is growing are also kicking in, like productivity growth, which hit its highest point since 2011 at 2.4%. As far as valuations go, equities are moving towards our near fair value. We're looking at the price to earnings multiple, or today's price on the S&P 500 relative to the next 12 months of earnings. The market is slightly above the 25-year average, which is 16.2%. Currently, at the end of April, we were trading at 16.9 times forward earnings. We think there's still likely upside in multiples relative to what we see in inflation. Strategic Research has done a study, and their findings are when inflation is under or near 2%, multiples historically have traded closer to 18 times earnings, so a slight upside to the current readings. As it relates to some of the headlines, China and the shifting trade deal has taken on a much more negative tone recently. We thought, and the markets I believe priced in, a likely deal sometime in May or June timeframe. That looks less likely as President Trump has recently increased tariffs on Chinese goods coming into the United States. So what effect will that have? Well, Fundstrat Global has viewed the tariffs as having a negative effect to earnings over the next 12 months by about 5%, or a decline of 5% on earnings over the next 12 months due to the higher tariffs. That also could result in about a 0.5 or 0.5% decline in GDP off of the estimates that we gave earlier. On the plus side, that would most likely force China to increase both their economic and fiscal stimulus domestically within China, which tends to have a positive effect on global growth. Overall, we think the dollar will probably continue to rise, which is not what we thought at the beginning of the year, which would probably hurt emerging markets going forward. So after a strong start to the year, we would expect some consolidation in the coming months. During the third year of the presidential cycle, and that's where we're at this year in 2019, consolidations tend to take place in the summer months, usually starting in late May and lasting till early November. So we may be a little bit early in that process, but that is to be expected. Finally, we get a lot of questions on the presidential election and the upcoming presidential election cycle from clients, and most of it has to do with the candidates' positions and their economic views. To be honest, I think it's probably too early to focus on any policies at this point. I believe there's 22 Democrats so far in the race. That number may increase. If you remember 4 years ago at this point, Jeb Bush was one of 16 in the race, and he was considered the front runner and the likely Republican choice, and we all know how that turned out. So regardless of who you think or you want to win, I would recommend looking at the approval ratings. Presidential approval ratings is almost perfectly correlated to the president's reelection. Currently, President Trump's a little over 40%. Historically speaking, if you get to 50, you have a good odds of being reelected. So that's something we're going to keep a close eye on going forward. So our closing thought would be, after weathering 2 corrections of over 10% last year, the equity markets have reestablished the uptrend, and we would expect to see further gains in the months ahead. As we have pointed out over the last few quarters, volatility will remain and should be expected at this point in the cycle. As always, the Fairport investment mantra is to remain focused on the long term and what matters to investment success in the years ahead, not just the next few weeks or months. That reminder brings us to the close of today's Fairport Flash. Our passion at Fairport is inspiring families, our clients, through everything we do. We hope our podcast inspires you to be in touch with your Fairport team if you have any questions about how any of today's general topics apply to your own portfolio. Look for the next Fairport Flash in about a month. Thank you.